Welcome everyone and Happy New Year. Before we get started and as we wait for participants to flow into the platform, I need to take care of a few housekeeping items. On screen is the ERIS content disclaimer. ERIS webinars, content, and media are created and published online for informational purposes only. It is not intended to be a substitute for professional advice. For a full copy of the disclaimer, please visit our website. Also, this webinar is being recorded and will be posted on the ERIS website in the next few days at erisinfo.com. There will be time dedicated to Q&A after the formal presentation. Please enter any questions you have in the Q&A section of the platform rather than the chat section, as we may not see them there. I am Scott Davis, Senior Vice President, Industry Engagement for ERIS, and we are pleased to host today's session, An Economic Outlook for 2023, the forecast for commercial real estate. While some industry experts predict a pivotal year for the economy, continued inflation and rising interest rates will likely persist, and questions remain. Can the Fed cool inflation without a hard landing for the economy? Can the labor shortage weather any slowdown? And what could it mean for commercial real estate? These and many more are the questions we will be exploring today. Joining us today, we are pleased to welcome Ryan Severino, the Chief Economist for JLL, a real estate investment management firm, where he is responsible for global and regional economic research, analysis, and forecasting, as well as property market forecasting. Prior to his work with JLL, Ryan served as Senior Economist and Director of Research at ERIS, then Associate Director of Research at MetLife Real Estate Investments. Ryan is also an adjunct professor of finance and economics at Columbia and New York universities, teaching courses such as urban economics, portfolio risk management, micro and macro economics. He also has experience in real estate asset management, portfolio management, and acquisitions. Ryan, over to you.
Thanks, Scott. I am going to share my screen and then we will get going. Well, thanks everyone for joining us today. As Scott mentioned, there are lots of questions as we head into 2023, and I'm going to frame it within the context of sort of the good, the bad, and maybe the ugly. Let me show you the agenda, and then you'll see what I mean by that as we get into it. I want to start with some of the good things that are going on. Unquestionably, there are good things going on in the economy despite some of the negative headlines out there. Then I'll spend a little bit of time talking about some of the things that are somewhat bad, giving us a bit of consternation as we try to think about where the world is going. Then I'll talk about the things that are maybe ugly. And I say maybe because superficially they might seem concerning, but I think the reality is they probably look a little scarier than they actually are. And then I'll discuss the outlook, including what it might mean for commercial real estate. Let's start with the good, because unquestionably there are good things going on. So let's start with the supply side of the economy. I think everybody knows that there have been significant supply disruptions over the last few years. If you haven't ever seen it before, this is how I like demonstrating that. This is an index that was created by the New York Fed, and it's really an all-encompassing index. It's designed to give us this complete view of what's going on with the global supply side of the economy. The only thing that you need to understand looking at this is that up is bad and down is good. And I've labeled a few important points in time on the slide just to give you some context. And you could see what we've gone through over the last few years is really unprecedented, at least in the history of the data that they've been tracking this going back to the late 90s. The good news is, if you look all the way over on the far right, is that the line has come down, and I think a lot of people are aware of this, that disruption in the global supply chain is not as acute as it was a year ago, even 6 months ago. And that's important because we need the supply side of the economy to function normally, whatever normally is these days, if we're going to get back to an environment where inflation is a little more benign and not as disruptive. We're not quite back to where we need to be just yet, but we are working our way back there. So this is a clear positive for the economy. The other thing that's happened, which is a little more supply oriented, is that we had a significant disruption to energy last year because of the events that are still going on in Eastern Europe. And I'm not an IR theorist or a military strategist, but I would simply say, at least to the extent that I've studied it, there tends not to be any upside risk to geopolitical events, or at least serious geopolitical risk. Tends to only really be downside risk. And I think that's really what we've seen over the last year, as evidenced by the run-up in energy prices. The good news is, as oil prices have backed off, we've seen gasoline prices peak in the United States sometime last summer, also start to back off. Even more recently, we've started to see some softening in natural gas, especially with how unseasonably warm winter has been in Europe. That's certainly been, I think, a help to natural gas prices. And I think some of the warmth that we've felt in, at least in certain swaths of the United States up to this point. So lower energy prices means effectively a lower tax on consumers, makes it easier for them to go out and spend, which is good because we need that to happen. One last point on this, we've also seen potentially, maybe crossing my fingers but not holding my breath, some signs that core inflation, once we strip out volatile components like energy, might also be peaking and starting to back off. We'll have to see what happens with the CPI data that gets released this week. But right now, we are at least seeing some tentative signs that not just that overall headline inflation, but real fundamental core inflation is starting to back off, which I take as at least a heartening sign, if not a reason to start shaking the pom-poms just yet. Some other good news, the labor market has weathered the last year incredibly well. It remains incredibly tight by historical standards. If you saw the most recent employment situation release from the BLS, the unemployment rate is still at about 3.5%. It's hovering near half-century lows. And the number of open jobs, which has come down a little bit in recent months, also remains near historically high levels. And that speaks to the incredible amount of demand for labor that exists. This admittedly is a bit of a concern on the part of organizations like the Fed, that they're a little bit worried about the labor market remaining too tight. But potential silver lining, what we saw in the most recent data for the labor market for December showed that it might be possible to have a strong labor market with wage growth softening and inflation softening. Once again, we will keep our fingers crossed on this, but certainly the labor market remaining tight has been an incredible proponent and propellant for spending in the US, which, with 70% of the economy still being driven by US consumers, remains of paramount importance. And that's exactly what we saw last year. At least year to date, we don't have finalized December data just yet. So through November, we saw another spectacular year for retail spending. There's no way that we were going to be able to replicate what happened in 2021 as we came out of lockdown. That is just really an anomalous number, but that really shouldn't diminish what we saw with consumer spending last year, that we saw what would otherwise be probably a banner year looks a little pale in comparison to what transpired during the prior calendar year. But I think what it does is it's really testament to the strength of consumers, that with the labor market remaining tight and consumer balance sheets remaining so strong, certainly stronger than they've been in a long time, that the consumer was able to go out, still spend money, put it to work in the economy. And that has been certainly not just beneficial to the overall economy, but certainly one of the things I think that has underpinned job growth over the last, call it the last 12 to 24 months, certainly in the services sector, which I'll discuss in a little bit. But make no mistake about it, the consumer is still in a healthy position. Most metrics that are related to the consumer, whether you're talking directly about spending or about the labor market or balance sheets, are still showing U.S. consumers in a healthy position as we head a little bit further into 2023. One of the interesting things that we see when we look at the data is that right now it seems like the boost that we got from e-commerce during the most acute phases of the lockdown is still holding, that we saw that one-time idiosyncratic jump up in e-commerce spending, and it stayed elevated. Now, I think everybody knows there's really no way that we were going to be able to sustain that pace of increase. That was really a one-time anomalous occurrence. But the history of this particular dynamic over time is that increasingly people are more and more comfortable, even more and more willing, maybe even they prefer to spend money online, and the amount continues to go up. Now, that said, that does not mean that this is the death knell for bricks and mortar retail. If anything, quite the opposite, which I'll discuss in a bit. But one of the things that I think has been interesting about the last few years, objectively interesting about the last few years, is that we have had this idiosyncratic jump up. It's one of the reasons why, as I'll discuss, the industrial market has remained so strong over the course of the last few years. So this tends to bode well, particularly for industrial, but I don't want anyone to take that as an explicit negative for retail. I think it's not quite the zero-sum game that people think. And speaking of which, when we look at the composition of spending over time, you also see something that reflects what we saw in the underlying spending data, in particular that e-commerce spend. What I'm showing you on this slide is the relative proportion of spending from US consumers on goods relative to services. And you could see, much like that idiosyncratic jump in spending associated with e-commerce, there was an idiosyncratic jump in spending on goods relative to services. Now, consumers generally still spend more on services than goods, but this has undoubtedly altered the composition because, again, during the acute phase of lockdown, not only was it easier to shop online, but that generally lent itself to people buying things as opposed to services, which usually have to take place in the presence of someone else, which was a much more precarious proposition a few years ago. But notice what's happened since that one-time shift. Even if we want to argue that spending on goods has come down a little bit in relative terms, it has not come down as quickly as some people would have thought. It's actually remained quite elevated relative to, well, certainly relative to pre-pandemic levels. And that's important because this is another reason why there's been such robust demand for industrial, as I'll talk about. But it also has translated into, believe it or not, demand for retail space. So again, I don't want people to think of these things as being explicitly pitted against each other. That's not really the case. That's not how I want people to think about this. But just to understand that there have been shifts that have been a little more durable, a little stickier, if you will, than I think a lot of people were prognosticating even just a quarter or two ago. But that overall puts the economy in I think, in a pretty healthy position. We're seeing a still strong labor market. We're still seeing consumers flush with cash. They're going out and spending. I'm generalizing, certainly. I don't want to make it sound as if there's no pain anywhere in the economy, but on a widespread basis, we're certainly seeing strength and momentum. We haven't gotten the fourth quarter GDP data just yet, but it certainly looks like it's going to be another robust quarter of economic growth based on all of the data that I've seen, based on all the models that I run. And I think that puts us in a position of having pretty good momentum heading into further into 2023. Switching gears a little bit, I want to talk about some of the stuff that's bad, or at least people are perceiving it as bad. And I think first and foremost on everyone's minds are interest rates and what the Fed is going to do. Now, I will be the very first person to remind everyone that there are still very good reasons why the interest rate forecasters Hall of Fame is completely vacant. That said, I am going to throw the Fed under the bus a little bit with their forecast and not mine, just to give you some sense of how things are shaking out. I think, as a lot of people know, we went through a very aggressive tightening cycle last year. The Fed raised rates basically from zero to about 4.5%. It's in absolute terms, it's the fastest tightening that we've seen since the early 1980s. In relative terms, relative to sort of the base where we started, you might characterize it as the fastest ever. The jury is still out on this, but I think most people, not just the Fed, but I think most objective forecasters think the Fed is not quite done yet. I think that some of that good news that I was talking about, labor market strength, deceleration in inflation, keeping my fingers crossed on that one, leads us to think that maybe the Fed doesn't need to get as aggressive as some of the most dire forecasts out there. I think there's a good chance that the Fed will probably end the Fed funds rate in 23 with a 5 handle. I've heard some pretty severe forecasts that have them raising to 6 or 7. That is a little bit hard for me to believe right now with the softening that we've seen in inflation. One tidbit on that, even just with energy prices pulling back and used car prices pulling back, we should see headline inflation get down to maybe 4.5% just based on those factors alone. So if we continue to see things unfolding in the right direction, I think the Fed will continue to raise, but maybe they don't need to go as far as some of the most the most extreme forecasts that I've seen up to this point. Now, that said, I think there's a really good chance that once they get to the terminal rate with a 5 handle, they will probably leave it there for a while. They're going to wait and see how this unfolds. They're very likely going to want to make sure that inflation is really heading back down toward their target and at a speed with which they feel is appropriate before they're willing to start backing off. I've seen some people who are even, incredibly optimistic, think maybe pessimistic if you look at it that way, think the Fed might actually start cutting rates in 23. I'm not sure I'm not in that camp just yet. I think I need to see a little more data on that, but I think it's reasonable to expect by 24 into 25 that the Fed starts backing off once growth has slowed enough, once inflation has slowed enough, and they feel like they're in what I would characterize as a safer place to pull back. I think my concern with this is, I think, I'm not a Fed hater, I'm not a Fed basher, but if we want to argue that they were, and I think it's fair to do so, that they were behind the curve in raising interest rates this cycle, I think the other side presents a lot of concern right now that they might tighten too much, potentially throwing the economy into recession. Again, I'm not squarely in that camp, as I'll discuss. I still think that there's a narrow path to avoiding that, but I do think that's where a lot of the concern lies, that the Fed is legitimately starting to get into what I would define as significantly restrictive territory, and that they're going to have to be careful not to push too far into that, because it could have a very dampening effect on economic activity. So I would say expect the Fed to continue to raise through the first half of the year, probably settling somewhere in the low 5s and holding rates there for a while before they start to back off. One of the second things that I think is important, it's not just monetary policy that I think is going to be a little more of a headwind this cycle, probably fiscal policy too. What I'm showing you on this slide is the year-over-year change in federal government spending. And you can see I've encircled the last few downturns on the slide. It can be a little bit hard to see, but suffice to say, in all 3 of the past downturns, when the economy was not faring well, the federal government does what the federal government tends to do. Tends to go out, borrow money, and spend it either directly or indirectly via consumers and businesses to try to prop up economic activity. In each of the areas that I've circled, you could see that there is a bit of a bounce. It's harder to see in 2000, 2001 than it is in 2008, 2009, and certainly relative to what we saw with the massive amounts of spending during the last epic downturn. It's not so much that I think government spending won't help at all. I do think with the most recent package that was passed last year, the $1.7 trillion or so spending package, that there's still some ability for the federal government to go out and spend money and be supportive of growth. I just don't think it's going to be quite the stimulative measure that we've seen over the last few years, where we have gone out and spent record amounts of money. Make no mistake about it, we are still talking about incredibly large amounts of money that the federal government spends in the budget. And I'm not trying to be a government basher or hater. I'm simply saying, coming off of the amounts of spending that we saw over the last few years, you're likely to see less of a direct stimulative effect that the federal government budget could have on the economy than we've seen over the last few years. It still might help a bit at the margin, but I think going forward, especially now with a divided Congress, and I am not a political person. I am a very apolitical person, so I have no latent agenda in saying this. I will simply say the probability that we get any kind of stimulus spending in the event of any kind of slowdown, that probability has gone down. I think there's a diminished appetite across the political spectrum. I think with divided government, that certainly makes it a more difficult proposition. So I would just say, government spending is not out the window completely in terms of its ability to influence the economy, but I wouldn't count on a lot of government spending. So between monetary policy and fiscal policy, we might find ourselves in an unusual position that we haven't seen in a very long time, where both of the main policy measures that branches of the government use to try to stimulate the economy during a slowdown, they might not be there. They might actually be some of the headwinds to growth that we're experiencing. And then the last thing that I think is not so great but noteworthy is that over the last few years, we have seen a decrease in both the labor participation rate and the size of the civilian labor force. Now, thankfully, both of them have recovered from some of the lows that we saw again in the acute phase of lockdown, but they are still both below where we were in early 2020. And that is one of the things that's presenting some problems. As I mentioned, that there's just incredibly robust demand for labor today. There is not robust supply, unfortunately. And some of this is associated with the pandemic and what we've seen over the last few years, but some of it is associated with demographics and accelerated retirements on the part of baby boomers. Some who might typically have returned to the workforce in some capacity have chosen not to for a variety of reasons. I still think there are issues with mothers in particular finding childcare for children. That continues to be an impediment. So the main takeaway from this is that we are in a structural labor shortage. It's not simply a function of what's happened over the last few years. That's going to make it difficult for employers to fill openings. As I mentioned, even with the Fed raising rates, we are still at a position where there are about, call it 10.5 million open but unfilled jobs. The good news about that is if there are any layoffs, and we've seen some up to this point, it should be relatively easier to fill those positions than we've seen in cycles past, where during a downturn there have been layoffs, and it's been, I think, very challenging for those people. It might not be as challenging this cycle because we still, even if that number is not exactly right, and I know that there is significant criticism of it, I think undoubtedly it's still an elevated number that probably portends relatively good things for the labor market vis-a-vis previous cycles that we've seen. I want to switch gears again and talk about the maybe ugly. And when I say maybe ugly, I framed it this way because these are topics that I get asked about frequently. And I think there's some surface level of consternation about these, but once you actually dig into the data a little bit, maybe not as dire as it seems. The first thing that I want to address is this question: aren't we already in a recession? And I think people are asking this question because if we look at the data from the first half of last year, certainly we saw contraction in GDP in the first quarter and the second quarter. But I think there are a lot of issues with that data. I'm not a conspiracy theorist, and I don't want to get into the weeds on it too much, but I just want to simply point out one inconsistency that I saw looking at the data. There tends to be a positive relationship between real growth in the economy and in industrial production. It's not a perfect relationship, but it's generally a fairly strong positive relationship. And it broke down for consecutive quarters last year in a way that seems, well, let's just call it unusual. There were definitely some idiosyncrasies in the data that made us wonder about this. I will simply say, based on a holistic analysis of the economy, not just one measure like GDP, when you step back and you look at the state of the economy the way the NBER does, who they are the ultimate arbiters of the business cycle, it didn't look like a recession. The labor market stayed strong, consumer spending was strong, industrial production was healthy. It was hard to find, I think, an objective argument that we were in a recession. And I know the back of the envelope definition of a recession exists, but I think in terms of true downturn in economic activity, we didn't see it. Last talking point about this, because I don't want to belabor the point. A lot of what occurred that caused GDP to contract in the first half of the year had more to do with what was going on with the rest of the world than really what was going on in the US. And by that, I'll specifically cite international trade. The trade deficit turned pretty sharply against the US in the first half of last year, but that was mostly because of weakness that we saw in other places in the world and their lack of desire for exports from the US, not so much because we saw any real issues in terms of the US economy, coupled with that resurgence in demand that I was talking about, consumers going out and buying things again. It's not hard to see how we could have gotten that kind of idiosyncratic bump down in net trade, which was not beneficial to economic growth in the first half of the year. The second thing I get asked about a lot is the inverted yield curve, because I think, as most people have come to understand, the inverted yield curve is one of the best predictors of recessions. And I've been asked this question a lot over the last few months. Does that inverted yield curve explicitly mean that there's going to be a recession? And my answer to that is no. An inverted yield curve doesn't cause a recession, but we can take it as a useful signal. If we think that for whatever reason that borrowing rates are really higher today than they are in the future, it could mean any number of things. What people usually take it to mean is that there's going to be trouble in the short term, that people would rather not they would rather not get into a situation where they're involved in short-term assets. They're a little more interested in something more secure longer term, and you start to see rates rise in the short run and then stay lower in the long run. I think this is more a story about inflation than really a bet on a recession per se. I think a lot of what's baked into the inverted yield curve is a function of the inflation outlook, and that it does become more benign over time, which I will talk about. So yes, it's a signal. Yes, I would pay attention to it. I'm not saying don't. I'm simply saying might be a little bit different this time around, which I know is a dangerous thing to say, because, as I'm fond of saying, the two most dangerous thoughts in economics are this time is different and that will never happen again. But it's a little bit difficult to disentangle those things. So we'll have to keep a close eye out. One of the other things I get asked about a lot has been the increase in debt balances on the part of consumers, especially credit card balances. Somebody asked when I was giving a presentation, before I could even get to this data, does the run up in spending just mean an increase in debt? And the short answer to that is no, because a lot of the spending that's been occurring hasn't been explicitly debt financed. But what I would say is, if you look at the overall trajectory that we're on, or we've been on sort of longer term, early last decade, that grayish line, and you follow the actual spending itself, that blue line, and you can see the blue line went through a significant downturn, has rebounded, still generally below the trend. So we're not even really back on trend just yet. So I would say, again, don't disregard the use of credit cards. I think there can be important signal coming through there. I would simply say, widespread panic about consumers' use of debt seems a little bit overhyped, overblown to me at this juncture than looking at it as any kind of particularly acute crisis. And then one of the last things that I'm getting asked about a lot is, how concerned should people be about some of these subcategories, particularly food and energy? And I would say, there's good and bad here, in the sense that, the bad news is that food and energy prices have gone up a lot over the last year. No doubt about it. I'm not trying to sugarcoat that. Again, with war in Russia exacerbating those things, it was almost inevitable. The good news, the silver lining, is that they are coming down, and they are, especially with the rollover in oil prices, they are starting to come down. I don't want to say considerably. That might be a little heavy-handed, but I think that there are good prospects for the year ahead, that some of these subcomponents are really going to come in. Food and energy, the core component of inflation, which the Fed pays so much acute attention to, and then even core commodity prices. We've seen deceleration. So I don't expect inflation to come down dramatically in the short term, but I would say for at least a few months, it's not just been the overall inflation data. Some of the big components have also been coming down, even though I would concede that they remain at elevated levels that do cause some concern on the part of some audiences that I present to. I still think that deceleration, that sort of disinflation that we're seeing, I think that's an important development at this stage of the cycle. So let's talk about the outlook. Speaking of this stage of the cycle, I will talk about a few very big picture items in the economy before I talk about the real estate market. So first and foremost, let's talk about inflation. I have been calling this my family feud slide because my top 11 answers are up on the board. They are color coded a bit. The ones over in the black box are more demand side factors. The one in the blue box are more supply side factors. And the ones over in that, I don't even know what color that is, that sort of tannish, brownish box. Those are more technical or mathematical factors. I don't want to go through all of them. When you get a copy of the presentation, you can read through them. The one I want to focus on is number 10, this idea that inflation is spiky. What I mean by that is when you look back at inflation on a calendar year basis, such as I'm showing on this slide, what you tend to see is that inflation tends to run up pretty quickly and then back off pretty quickly. Now, not immediately, it's not instantaneous, but it tends to kind of run up and then come back down. And as a consequence of that, you get kind of this spiky shape to inflation in a slide like this. Even during the 1970s with the oil embargoes that we faced, you also saw that kind of spiky pattern. So when I look at my forecast or anyone else's forecast for inflation for that matter, I'm not so concerned about nailing the forecast down to the basis point. I can't do that, and I'm not ashamed to admit it. If I knew exactly where inflation happened to be going down to the basis point, I wouldn't be working for JLL. JLL would be working for me. But what I could say is I feel reasonably confident in the overall trajectory. And by that, I mean, I think there's going to be a fairly significant deceleration in inflation this year. And then again, it's going to be hard to maintain, especially as we continue to see the supply side improving, as we might see more demand softening with rates going up. So I would say just follow that general shape of the curve. I think there's meaningful disinflation this year, and then continued over the next couple of years, even if it's a lot slower than what we're likely to experience during the course of 2023. Given that, I think we're also seeing economic growth slowing down. And this is where, admittedly, the crystal ball is a bit murky. I still think, based on that positive data that I was showing earlier, I still think that there is a narrow path to avoiding a downturn. That said, it is pretty narrow. And I think there already is, if I look at the data, a slowdown in the economy. Now, how bad that gets, you could see sort of my base case forecast on this slide. I think growth slows down to about stall speed, relatively close to zero, but doesn't completely give out. That would be significant. That would be very helpful relative to the last couple of cycles where we saw significant contraction in GDP and a pullback in all sorts of economic activity, including those related to commercial real estate, especially I think during the last downturn. I'm not sure that's the case this time. I still think that I'm not trying to be overly optimistic, but I still think that there is a path that the Fed might be able to take that avoids the worst of this. So I'm playing a probabilistic game, not a game of certainty, but I still think that's true. And with the data, looking more optimistic over the last few months, it's probably, I feel better making that assertion now than I would have even a few months ago, where I probably had a little bit less conviction in that than I do right now. If we look at the ERIS data, I want to start to think about how this is impacting commercial real estate. So what you see in the data is activity on a calendar year basis over time. And it's interesting to me because you could see from, generally speaking, I'm going to make a bit of a generalization, so I'll apologize in advance, but, 19 to 20, 20 to 21, 21 to 22 starts to see generally like there's an increase in activity. If you look all the way over on the right, and this is something that Scott and I went a little bit back and forth on the data earlier this week, maybe tentatively, perhaps a little bit of a slowdown toward the end of the year. Now, I'll point out in prior calendar years that was the case, but we'll have to see. Is it just kind of a seasonal thing? Does it portend something else in the commercial real estate market? I think it's an interesting leading indicator as we start to think about where the real estate market might be headed over the next 12 to 24 months or so. Speaking of which, let's talk about the transaction market environment, because I think we've seen another good year, no doubt about it, but we're starting to see liquidity slow down amidst pressure from honestly, from higher interest rates that have come to bear on the market. And I think both a real and perceived slowdown in economic activity. I think that's caused some deals to reprice, some deals to fall out of bed, some people to take longer doing their due diligence to wait to see what happens. But all of those things, I think are evident here when we take a look at this. That said, I think we still think it will be another good year for transaction volume, even if we can't really replicate the record pace that we saw last year. Well, I guess it's 2 years ago now, technically, in 2021. I think most people still feel objectively good about the fact that we did see, some decrease in transaction activity associated with the disruption, but that it came bouncing back, pretty quickly to the now where I think we'll be in for another good year, even if there's some potentially some fourth quarter softening. With that, I want to dig into each of the major commercial property types a little bit deeper. I want to start with industrial. As I said, with e-commerce looking so strong, with that shift in consumption towards goods that has remained, it's an incredibly strong real estate market, record strong. You can see on the slide, I'm showing you the year-over-year change in asking rent. There's nothing approaching what happened last year. So some good news and bad news there. So the bad news is no way that's sustainable. We're already seeing in the data that there's clearly deceleration in asking rent growth for industrial. But the good news is we don't expect to see the kind of downturn for industrial that we've seen historically. I do think there's going to be a deceleration in rent growth and some softening, but I don't think it's going to be a mess the way that we saw again with the last true downturns. And I mention that because when I run the model to produce the forecast for industrial asking rent, usually I get pushback and people say, why is it slowing so much? Well, why is it slowing so much, right? What is that due to? And I talk about how there's been some increased supply, that we don't think this demand level is sustainable. It starts to back off. We'll see if that's right. I will be honest and tell you, as much as I like my models and as good as I think they are, they've been a little bit undershooting on rents because industrial rents have just been so strong over the last year. Maybe it's kind of on the opposite side now, right? Maybe maybe we'll actually see something that is better than unfolds. But I don't think that'll be the case. I generally expect there to be a slowdown, but it's still healthy environment as we push further into this decade. If we think about the retail market, the retail market kind of comes in for a beating, doesn't it? I think everyone's been proclaiming the death of the retail market for at least the last 20 years, if not longer than that. What I would simply say is that we have seen both rents and vacancies hold up much better than almost all people I know, not so much the real estate experts, but most of the average people I know seem to think. We continue to see quoted rents going up over time. We continue to see the vacancy rate come down. It's been, I think, an impressive run on the part of a sector that has been somewhat, maybe fairly, but somewhat maligned lately. So I still think there's room to run there. Again, it goes back to what I was saying earlier. We have a healthy consumer with flush balance sheets and a tight labor market. I'm not saying there won't be any disruption. Certainly the retail sector feels it pretty directly when that happens, but so far so good as we start to think about that world. And then lastly, thinking about office, the point I would make about office is it seems, stressing that, seems like work from home is settling into kind of an equilibrium around 30 to 40%, that employers are okay with that workers are okay with that. And I mention that because one of the things that has characterized office, not just since the recession ended, but even before, has been this, I don't know what you want to call it, the shift trend toward higher quality space, sort of the flight to quality. You've probably heard some people talk about it, but the very pronounced flight to quality that was evident before the downturn. It's certainly been evident since the downturn. That has exacerbated the rift between the have and have-nots in the market, and that's made it very difficult to talk about overall market performance. This dynamic that I'm showing you on the slide exacerbates that, because if you're going to generally attract people back into an office space, it's got to be palatable to them, right? It can't feel like they're going in to sit at cafeteria style tables under brain melting fluorescent lamps. Maybe that worked over the last 10 years when labor was in a weak position, but with labor in such a strong position right now, that's going to be very difficult to do. So I would say these things are related to each other. The better the quality the property is, the better the performance, the higher the occupancy, not just economic occupancy, but I think even physical occupancy. Those things are certainly related to each other. So much like retail, I think increasingly over time, we're painting with not as broad of a brush when discussing the sector as we would have just 15, 20 years ago, something like that. All right, so what's the so what of this? It's one thing for me to tell you a moderately interesting and entertaining story about the economy and real estate. It's another thing to have something that actually matters in talking about that. So what's the good? The good is that we have momentum heading into downturn. That should certainly mitigate its impacts both on the economy and commercial real estate. The bad is that policy is likely to present a headwind to growth, if not cause any downturn. Again, both fiscal and monetary policy have turned a little more restrictive in a way that we haven't seen in a while. So keep an eye on that. And then the ugly, some of those indicators I talked about, they might not be as ugly as they seem at first blush, but I would say still warrant paying attention. What's going on with the labor supply situation, what's going on with debt, what's going on with interest rates. Those things are all ultimately connected to each other. With that, I am going to shut up, but I'm going to turn it over to Scott, and I think I'm going to stick around to address any questions that I did not during our riveting presentation this afternoon. Scott, back over to you.
Appreciate it. All right. Yeah, let's turn over questions. We have a few here, and we'll go through as many as we can before time is up. Let's get started. Can you share some of the high-level thoughts on the recent political news? McCarthy being appointed Speaker of the House. They are talking about a potential significant conflict on Congress where budgets will have trouble getting approved, potentially putting the U.S. in a worse recession. What are the chances of this happening? How bad could it get?
So the short answer is it could happen. If you take the horse trading that went on in order for him to become Speaker at face value, it's a possibility. The good news is I think everyone realizes if they struggle to do something like approve a budget for too long, and I'm not just talking about the Band-Aid budgets that we sometimes pass, but a more meaningful budget, or dare I say that they really play with the debt ceiling, trigger some kind of default or scare the markets enough. I think people realize after last decade the dire consequences of that. And I'm not saying you have to take a political stance of being for or against debt or for or against the debt ceiling. I'm simply saying they're going to have to be very careful about that. I don't think it's a high probability scenario that they would upset the apple cart completely, but I don't think we can rule it out after some of the political wrangling that went on over the last week. So we're going to have to hope that when push comes to shove, cooler heads prevail and we don't make any potential slowdown in the economy worse than it might otherwise be.
Okay. Next question. Is there another time period going back 50 years where you would compare our current recession to another one, perhaps the early 80s or 2009 to 12? Is there anything different now that would be a factor in how quickly we would come out of it?
It's really hard to draw I think there are bits and pieces that are similar. Obviously, inflation hasn't been this high since since the 80s, and that I think draws comparisons. We haven't really seen a significant supply disruption since the 1970s, so that draws comparisons. It's hard to draw a clear parallel to this. I would, but to the ultimate point, at this stage, it does seem like, we're really beyond the worst of at least the economic side of things. If you look at how the economy performed for the last, really the last, I guess it's the last 8 quarters now. It's really been, even with the disruption in the first half of last year, it's been on a very good run for the last 2.5 years. So it's hard to draw a good comparison. I think people are quick to do that, but there's no reason to think that depending upon exactly how aggressive the Fed gets, that we shouldn't be on I think ultimately another good run for the economy, whether that is a short expansion and a brief downturn followed by a longer period, or just something that lasts for longer, I think remains to be seen. But I don't think that there are any reasons why we can't have good performance from the economy moving forward.
I thought it was interesting if you showed that graph of that inverted yield curve. And if you looked at it in the past, you can see with the previous recessions, and you look at it up to current date. I guess my question is that telling that it's potentially really it's going to happen or not?
It's not a guarantee. One of the tough things about the inverted yield curve is that the timing is always uncertain. It could be historically based on the data 6 months, 12 months, 24 months, might be never. As I said, we're in a very unusual economic time. I think a lot of what is happening with the inverted yield curve is based on deceleration in inflation, and that's the kind of thing that will actually help the economy. So we're gonna have to keep our fingers crossed on this and see how this plays out over the next 6-12 months or so. I still think there's a path to avoiding it, even if it's fairly narrow.
Okay. Next question. I recall a significant escalation in energy prices well before the Ukrainian conflict that appeared to be a part of the current administration's energy policy shift from domestically harvested fossil fuels to other sources. I expect energy prices to remain high relative to 2019-2020 levels. I'm curious if you agree and how that may affect your forecast.
I think the wild card that's still out there is what's going on in Eastern Europe. I think we'll have to see how some of that plays out. The other thing I would say to keep an eye on will be demand from China. I think right now China is going through a very disruptive period where it might not seem like it's going to add to demand around the world, but once they get through that transition to the other side of things that feels a little more reasonable, you could also see China become a contributing factor to demand for energy on the world stage, and that might, that boosted demand, certainly relative to the supply levels, that potentially could put some upward pressure. I don't think that we're going to see a repeat of what we saw this year with oil prices spiking and gasoline prices spiking, but I do think that there's some potential for at least maintenance in elevated energy prices based on the situation in the Ukraine and in China this year.
Okay. Next question. Given your expectation on rates, what would it take for the Fed to cut rates in 2023?
I think if there were a much more material slowdown in inflation and in particular in the labor market than they're anticipating, then because the thing with the Fed that everyone has to remember is that number one, that those are just forecasts, they're not wedded to them, and number two, they need to sound like they're playing hardball because they need to convince people that they're serious about inflation after kind of convincing people that maybe they or getting people to think that maybe they weren't so serious about inflation. So even if they thought there might be a path for them to come out and cut, I don't think that they would ever say that. And I'm not accusing them of sort of shady dealing or anything. I'm simply saying that forward guidance is part of the Fed's toolbox at this point, and they're going to need to use that in order to manage the situation. So they don't want to disrupt their ability to use that. But I think if we got into a more pronounced slowdown than they were anticipating, especially if the labor market deteriorates a lot more than they were anticipating, then I think it's very easy for the Fed to pull back on that forecast. And if you just want evidence of that, look at what they did last year relative to what they said. Those things almost couldn't be more diametrically opposed because they responded to the data as it came in hotter than they thought. If the data comes in weaker than they're thinking, there's still a way for them to start pulling back on rates, no doubt about it.
Okay. What part of the commercial real estate by property type would you say is going to have the biggest decrease as far as transactional volume, do you think, versus which one, the other one would have the probably most, like versus, retail versus industrial or office, so forth? I know you went through that, but which sectors in that industry are going to potentially be really weak?
In my mind, I think the one that's still a challenge is office, and that's just because there are so many unknowns that everyone's dealing with. We're trying to see exactly how the work from home situation settles, what return to office is like. We've gone through a fits and starts pattern of that over the last couple of years. I don't think it's an indictment of the property type itself. I think there's just a lot of sitting around and waiting to see how this shakes out. And I think the further away we go from, real acute lockdown and working from home, the more transparency we'll have on that, the more companies will be able to make decisions. And you're starting to see it now, at least at the margin. You're starting to see companies make decisions about how many days they actually want people in an office and how their employee base is responding to that. So again, I don't think this is the death knell for office. I think that narrative has been greatly exaggerated, but I do think that there are a lot of people who are waiting around to see what happens with this. Whereas industrial, I think the thesis is pretty well understood at this point. I think even an apartment where there's some disruption going on, I think the apartment thesis is pretty well understood. And even retail, as much as retail is undergoing this continued evolution, I think the retail thesis, I think is within reason understood. I just think the office market still needs to get through this period because there are a lot of surveys out there. There's a lot of conjecture, but I don't think anybody knows definitively what's going to happen. So I would say once office gets through that, then I think you could start to see a little more movement in that sector than we've been seeing recently.
Yeah. Do you see multifamily increasing because as interest rates increase, it prices a lot of buyers out of the market for homes? Do you think that is a property type that could see an increase?
I'm still optimistic about it for the reasons that you mentioned. So I think what's important to understand is that there is a significant under shortage of housing, especially anything that's remotely deemed affordable in the U.S. For sale housing, for rent housing. It's not immune to cycles. It's not immune to what's going on with interest rates. But I take heart. I shouldn't say it that way, but from the market's point of view, I think what matters is that even through all the ups and downs, that we are chronically undersupplied in housing, and that it's almost always a good, certainly rental housing is a good bet in the certainly in the medium to long run. If anything, we have expectations of this housing shortage lasting for, I think, a fairly significant period of time, especially in the places where we probably need housing the most. And so I'm still cautiously optimistic about the apartment market, especially in the workforce sector. I do think there are pockets of in some places where we've seen a lot of class A and higher development. Maybe we didn't need all of that necessarily, but I do think in the more affordable and I'm talking about market rate rentals, not any sort of rent control or stabilized segment of the market, that kind of class B/C segment of the market. There's just incredibly strong resilience there. There are reasons why historically we've had on average about a third of households in the US are renters and not homeowners. We went through a period of time in the 90s and the 2000s where we tried to change that. It didn't work out so well. I would expect that to persist going forward, which creates, I think, this pretty durable pool of demand set against the backdrop of a supply that we know is insignificant relative to demand. So I'm still, I can't say everything's going to be champagne and roses for the next 6 months in that market, but it tends to rebound pretty quickly, and after that it tends to perform well. So I'm still an optimist about that sector overall.
Yeah. Commercial real estate is a key component of the economy. And it seems like it is greatly affected by the interest rates. And what we're hearing is as interest rates continue to rise or elevated, that they're impacting deal flows. I know we're hearing from some of our environmental consulting contacts and all that their deals are down 25 to 35% in volume when it comes to transactional due diligence. If as the Feds, I think you in your graph you're showing like maybe 2024 they'll maybe start to come down. What do you think as far as the market comes back for commercial real estate? Will it be like drinking through a fire hose, or will it be gradual, or what?
Now, I think it's one of those that it will be gradual at first, and then it might feel like the floodgates open. I think what will really be a catalyst for that is once expectations about the trajectory for interest rates change. I think once the market gets its head around the idea that rates will start to come down, that I think would be a good catalyst for that. I think part of the problem, as I mentioned earlier, is that there are different forecasts out there, some of which are fairly dire, that some people, talking heads, go on Bloomberg, CNBC, places like that, or publish their research, talk about the Fed going up to 6%, 7%, scares a lot of people. I think once we get to that terminal rate and we can at least see the light at the end of the tunnel in terms of rates coming down at some point, I think that will be an opportunity for the people who are usually at the front end of the curve to go out and be a little bit more aggressive, the way that those participants in the market tend to be. And then I think those that are a little more circumspect tend to follow along, and that tends to turn around pretty quickly. I think certainly relative to what we saw with the financial crisis, because this wasn't a balance sheet recession, I think it would probably, I think it's more inclined to play out better than that, where it took a while for transaction volume to really come bouncing back.
Okay. This will be the last question. Can you describe how the COVID pandemic interrupted the business real estate cycle and how remote working is affecting office and hotel segments?
Yeah, I would say, it disrupted in positive and negative ways depending upon the property type. Obviously, it was a positive for industrial, was a negative for office. It was a negative for hotels, probably, if I'm probably even retail for a while. I don't think as long as it is, say, office, because we got through, I think, the kind of the acute phase relatively quickly. But you could almost say it was and then it wasn't, because we've certainly seen, I think, a pretty or a more robust rebound in industrial than people would have thought. So maybe in the beginning it was a negative, and then once vaccination really started, people started going out again. It was the floodgates open. There was almost sort of that revenge shopping. I think the most lasting impact is probably going to be on business. We're going to have to see exactly where return to office shakes out. We're going to have to see exactly what happens to business travel. Business travel's come back. Conventions has certainly come back, but I think they haven't bounced back as quickly as the leisure side. A lot of the revenge travel that some of you yourselves might have been going on over the last year and a half. We haven't quite seen that resurgence. And I think especially with the economy slowing down, we've certainly seen businesses pulling back on budgets and travel budgets. So those things are a little bit difficult to disentangle. But I think once we get on the other side of that, we'll have a little more transparency. I don't think things will seem as dire as they do right now, but I do think that there's been a bit of a permanent shift in the way we work, which obviously has the most direct impact on office and hotel, at least, hotels that cater to business travelers. Okay, well, unfortunately, that's all the time we have for today's presentation. To read more about commercial real estate or environmental due diligence, please visit ERIS Info Hub on erisinfo.com.
which contains articles, podcasts, and webinars on the topic. Please note this webinar has been recorded and will be posted on the ERIS website in the next few days. On behalf of ERIS and our audience, I'd like to give a big thank you to Ryan for sharing his expertise and insight with us today. And to our audience, we want to thank you for your attention during this past hour. We look forward to hosting you at our next ERIS webinar on Wednesday, January 18th, when we will host our virtual demo of our new report authoring platform called Scriva. The link is in the chat, but also on our website at the homepage, erisinfo.com, where you can also get a full list of upcoming webinars and recordings of past webinars. Click on the Info Hub tab under webinars, and you'll be able to see the list. Please enjoy the rest of your day. This now concludes the webinar. Thanks again, Ryan. Appreciate it.
Thanks very much for having me.
Take care.